And when we look at the economy, when we look at where we're going with the economy and what we're doing, you can start to see changes happening. And when changes happen, we need to be malleable. We need to make changes with the investments. And ultimately, when we do that, we can help preserve, protect, and then look to enhance your overall wealth plan. That's the goal here, that when changes are needed, we can make the changes that are necessary. There's a lot going on right now with the markets, the economy, inflation, and just geopolitical. Now, I want to put this into context of some things that we can be thinking about a little bit more. So imagine that you're in a competitive chess match. Now, I understand that you may or may not like chess, but think of it this way, that you plan your opening moves, and I'm sure you've seen some videos, some movies of people playing chess, and the opening move is a critical piece to actually winning. So you may have then the advantage in the early stages, but suddenly your opponent makes a move that you weren't expecting, and now the entire game has changed. Now that is what we're talking about here. That is what's happening with the markets and the economy. You see, we came into this year expecting that we were going to see growth of the economy and some growth of inflation. So we called that lead 2. But changing of not only elements of our economy that we're starting to see now over the last week with new data, changes that are starting to see on the geopolitical front, on many different elements, that actually is starting to signify different things. So now you can see the NASDAQ, the S&P 500, the Dow Jones, they're all sitting at their 200-day moving averages. And now we're to a critical point. And here is where we start to understand the dynamics. Is this a buying opportunity? Or is this the start of a major breakdown? And the question right now, that's on my mind, and that's probably on your mind. What is the right move with your hard-earned wealth right now? As you're thinking about things, you have many questions, I would not doubt. Will the markets hold and then bounce? Are we about to break down? What's driving this uncertainty? And how should you respond? Well, all of these things are really what we're taking a look at right now, in the different ways that we can be looking at the markets. And what's most importantly is what's the right strategy that's going to help you with your wealth plan in this environment. You see, we're taking a look at all the different dynamics. And yes, we're at a critical inflection point right now, especially with inflation, with our trade policies, and then what the Federal Reserve is going to do and what that decision means for you and your investments. So how do we strategically position our portfolios in these times of uncertainty? The questions go on. But just like in chess, when we control the board, especially in chess, the center of the board, that's a key element. So investing, the 200-day moving average is like the center of the board, and it's a crucial level that often dictates what happens next. And right now, like I mentioned, the 3 major indices are really at this level and testing a breakdown. So yes, this is called a dip. But do we buy that? Especially if the S&P 500 moves below it, especially if the NASDAQ or the Dow drop below that. You see, they're only off a number of percentage points from the top of their highs. But what happens if they start to go down? Well, then you start to see mathematically that we actually start to go down faster. And here's what makes this a critical movement. Like I said, our opening move for chess was the fact that we were in lead 2 with our economy actually increasing and doing better, and the fact that we had some inflation. But now over the last month, we're starting to see the opposite. So inflation is starting to slow. That's a huge change. And now we're starting to not only see that for February, we're starting to see that for March, and possibly even throughout the second quarter, which again is a change that's just been happening within the last few weeks. So that right there is a change of the markets. But then we take a look at where we're at for other elements of inflation, whether it's where we were seeing the headline inflation for January at 3%, but February was 2.86. March, we're projecting down to 2.5, and then even into quarter two starting to slow. Well, that is not because of the fact that the Federal Reserve has been doing a great job on inflation. Actually, it's because of the fact of some of the other uncertainties that are out there. So when we take a look at different elements from the wars of Ukraine and Russia, or whether we are taking a look at some of the different tariffs that are out there, you can start to see that we're going to be less aggressive with rate hikes and actually may have more rate cuts coming. We're not really reacting to inflation anymore. We're actually reacting to the fact that it's slowing, and that is a completely different environment. So yes, we still are seeing the fact that the Federal Reserve may cut interest rates now, and that is because of the fact that inflation is slowing enough, but also with uncertainty. So when we talk about that with trade wars and some of our policy shifts, the uncertainty is building. And when we talk about how we can be changing our policies in the US, whether it's a 10% increase on Chinese tariffs starting in March, 25% on semiconductors, when we're talking about foreign restrictions with Mexico and Canada and other US companies, what they can and cannot do, you start to see how this can have a ripple effect. If that actually starts to happen, then we start to see corporate earnings start to come under pressure. And the high tariffs could really cost some of these businesses with some of their imports. We could also see then a global economic slowdown that starts to happen with some of these trade wars. Now here's the thing though. Right now, we are coming into taking a look at corporate earnings, then that's where we have higher tariffs, and it can mean actually that businesses that are heavily reliant on imports can get hurt. But then we also have the economic slowdowns that could happen, especially if some of these tariffs cause trade wars. So you can start to see this as negatives. But here's the other element that is really actually inviting right now, and one that we're really watching pretty closely. Because right now, the US, we're in lead 4. So that is the Lions Wealth Economic Activity and Development Stage 4. And what this means then is that we have a slowing of growth of inflation and a slowing of growth of our economy. And when we put them in tandem, that actually is a pretty bad place to be. But when we take a look at Europe, and this is where mathematically right now we're starting to see things get better, not worse, they're in lead 2, the Lions Wealth Economic Activity and Development Stage 2. And what that is that yes, they have a slowing of some inflation, but on the similar element, most of their inflation is still going up, still increasing, but they also have economic growth, which they have not had for a while. You can start to see how these cases that we look at, like the Smoot-Hawley Tariffs Act of 1930, that actually raised tariffs on 20,000 goods, leading to a retaliation from all of our trade partners, actually resulted in a huge collapse of our imports and exports when we needed it most during the Great Depression. Well, that's, yes, we're not saying we're there today, but those case studies, those things are historical, and we do want to take a look at them, but today is so different. Yes, the US may have a couple of months or a couple of quarters where we're not having as much growth. Yes, we can have some trade tensions that are starting to crop up and some economic uncertainty, but that is not where we're at with actually most rest of the world. And if we're taking a look at Western Europe, if we're taking a look at some of the emerging markets, those are all other very good places that are still showing some very positive growth. So that's another element. Then we take a look at the Federal Reserve and the dilemmas now that they have, because they're really caught between a rock and a hard place. If they cut rates too soon, actually, they can reignite our inflation. But if they keep rates too high, that could slow our economy even further. And with the Atlanta Federal Reserve just coming out last week, that now for second quarter, they're actually projecting negative growth. That was not what Wall Street was expecting. That's not what we have priced in. And so what happens then, let's go back to our chess game. It's a challenge. Changes happen. And now we can actually start to take a look at your wealth plan and start to say, do we need to abandon our strategies entirely? Or should we just make some readjustments based upon what's happening today? And that is where taking a look at what you own as part of your investments actually really helps. So we need to stay flexible. And right now we're expecting more of a sideways market. And that gives us a really good setup to see some bounces, to see some times where we can have some growth, but ultimately, if we're going to be moving sideways, there are other investments that we can be putting into your portfolio. But it also means that we have to have patience as well. Sometimes we can grow, other times we're looking to not lose. And when we take a look at our selective buying opportunities, there's still some great areas to be. When we take a look at defensive and quality investments, European investments, we can put those in that can provide some cash flows. We can provide some dividends. We can provide some great sectors. Sometimes utilities and healthcare, consumer staples can all hold up very well during slowdown. So now we don't have to be reliant. And I know you have a lot of money that's tied up in many different areas, from real estate to different parts of your retirement plans. All of that works. If we make some small, minor adjustments, we can be looking at different things to help reduce the risk and help for the potential for increased returns. So that's one of the elements. We watch also for what the Federal Reserve is signaling, and especially with the market cues. And if they start to say more rate cuts, well, then that means that we're getting a little bit more soggy and that the economy is slowing a little bit more than what we expected. But if we have a stronger bounce, if we have more growth starting to come back, you actually will see that those rate cuts aren't needed. So that's where we are taking a look at many different elements. But then don't let the market noise distract you. And this is where we come back to having what we call the signal. So yes, we have the ways that we're basically looking at all the different stocks, all the different investments, and we have our trade levels. So above those levels, mathematically, those investments are likely to go up in value. Below, they're likely to go down in value. But then we also have the signal. And the signal says, should we be invested into that investment or not? Should we actually be there or not? Should we stay in bonds or should we move out? Should we stay into high growth names or should we go more conservative? And that signal is actually what helps us to navigate the headlines, navigate the markets. And so we're not playing catch up, but we're also not just bouncing around to what we think is working. The signal is what really helps us. So when we take a look at the price, the volatility, and the volume, how many stocks are being traded on a daily basis, that helps us to come up with a signal. And it helps us to not act emotionally and helps us to stick to an investment plan that ultimately is going to help you with your wealth plan. Take a look at a well-laid investment plan that can help us to have a well-laid foundation for your wealth plan to come. And like I said before, just like your moves in chess are critical, having a little background of where we're at right now, if bounces happen or if breakdowns come, we can remember that we don't need to panic. We just make some adjustments. That's what I want you to remember. Subscribe to our YouTube channel to stay up to date. And we have more of these there as well. So like this video so that others may find value here, and drop us a comment as well. You can email us, you can reply to these comments. We'd be happy to hear from you and actually look to discuss if a personalized strategy specifically with some of your investments is going to help your wealth plan more. So we'd love to talk about that. And remember that investing here is the long game as well. We want to play it wisely. Ultimately, that's what's going to make for a better wealth plan in the future for you and your family. Take care.